Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
All right, welcome back, everybody. Another episode.
Ready to roll.
Part dos of our venture into self-directed accounts.
Yep.
So if you're hearing this
world.
and you haven't listened to part one, highly recommend. Go watch part one, get through that, and then come back and watch this because it'll make a lot more sense. Because we're going to get into more depth of some of these solutions
on the self-directed side.
Self-directed side that we talked about from at the end of part one.
Right. And what's important as well is you brought up a great point. If you watch Empire Strikes Back before you watch A New Hope, now there's no reason to go watch episodes 1, 2, and 3 because they're just kind of useless.
They really are.
But if you watch episode 5 versus before episode 4, you might be a little confused. It's like, who's this Luke dude and why is that? Yeah. So,
Yeah. So go watch part one. Okay. So for all of you that have watched part one, here we go. Part two. Now let's just reiterate one point to this that will kind of launch us into this.
One
point. Or port.
Part and point.
Yes.
One part and point.
Yep.
A port. Okay.
Exactly.
Yeah.
Because, we talked about there's problems with your self-directed or conventional hybrid accounts, and we want to alleviate those obstacles. And so how do we do that? Custodians, particularly self-directed custodians, there's going to be kind of a lot of nickel and dime fees here and there. That's how they make money. Yep. But we need to address that. How do you have access to your money to invest? How fast can you access it to invest?
Right.
Do you have somebody to work with who can advise you, walk you through, kind of be in partnership with you, that kind of thing? Who's going to help you?
Right.
And then big problem that we talked about is how cash at a self-directed custodian just sits and does nothing. There's no option for that cash unless you're putting it into something. What are the other options? What can you do?
Seriously, like $400 million in cash.
He's going to say $400 million
like
24 times.
And okay, here's the thing. It's like in the custodial world, that's not a huge amount of money. Right. It's not very large, but
still,
if any of my dollars are part of that $400 million, I would be so freaking frustrated. So don't.
As we have seen, many people are that frustrated.
There's some random, I can't remember who the ad is for. Obviously, it wasn't very effective marketing, but there was some ad that I saw that's like, and it tells like, this is Bill and he does this wrong. Don't be a Bill.
Yeah.
You know what I mean? And it's like, okay, don't just sit in cash. That is the dumbest thing I've ever heard. Unless you want, I mean, that's fine. If you want to sit in cash, do that, but it's dumb.
Yeah, someone might need to stay in cash, but if you got $400 million.
Yeah.
If I had $400 million, I wouldn't let it just sit in cash.
You would be in cash.
Yeah.
Because you would just be spending. You don't have 400? I thought you had $400 million.
$350.
Okay,
so let's talk about these self-directed custodians, right? One of the big thing that...
The Wild West.
Yep, the Wild West. One of the things that comes up when you're in the Wild West, right? And you have to... Imagine if you were out and you had to then go back into town and get permission if you wanted to spend your money on buying a new cow to put in your herd of cattle.
New cow.
A heifer.
Yes.
Right?
Okay.
You just want to make the transaction immediately.
I want to buy a heifer.
You want to buy it immediately. You don't want to have to go get permission from the sheriff in town.
The new sheriff in town.
If you want to make a purchase. So in self-directed custodians, right, if your money is just with the custodian, right, you actually have to go through them to get permission, even get the money out of the account. So... right? There's a fairly common term of checkbook control that is used to do that. Now, we have a couple of ways that we work with that. So, Ty, get into a little bit and talk a little bit about, what how we sort of work that checkbook control.
Absolutely. So coming back to your point, right, in that self-directed world, there, and remember, so I want to take one more step back here, that in the self-directed world, it's either a self-directed IRA or a solo 401k. Both of those have the same functionality as far as what we're going to talk about right now. Yeah. Right, the checkbook control and really you taking control. So you can do it with either or. But we're going to talk about some benefits of the solo K in just a second. So in the self-directed world with qualified dollars, with retirement monies, seriously, there are still custodians that I want to clarify that when you don't have checkbook control, you literally you have to send a document to the custodian for them to sign the deal and process. And I'm telling you, it's like weeks. And again, if you need to get earnest money in on a deal in today's market, can you wait 1 to 2 weeks for that to happen?
Well, and sometimes it's not even, they just need your signature. They actually require other documents.
Yeah. Oh, yeah. Like, it gets so crazy. Yeah. And again, I get it. They want to triple check all the T's crossed, I's dotted. I get it. But here's the other thing, too.
The sheriff wants to make sure you're not stealing someone's cow.
Yes. Let's see the brand on that. Their heifer. Yep. So the other thing, though, is, and this is kind of the cat and mouse that I think their game they play is, there usually is like an expediting fee that you can pay of like $50 or $100.
That's a good fee. That's a great fee. Yeah. Do you want it faster?
So there's that level. Then the next level is the checkbook control that some custodians allow. But here's an inherent problem with that. Is that, think about it. Now you've transferred from Fidelity to self-directed custodian A, and then self-directed custodian A has to then send the money to Wells Fargo, Chase. And here's the problem too with that. You go to Chase or Wells Fargo or Bank of America and say, hey, I want to open up this account for my LLC or for my trust or for my solo 401k. And you are going to get looked at like
you're an alien.
Like an alien. Exactly. They don't even know what a cow is.
They're going to be like, this cow. What town you from?
Where you ain't from around here, because you sound funny. Really, seriously, that's exactly what it's like. And I'm not kidding you. I have a good friend of mine who has one of these accounts, and he literally went to 7 different banks. 7 different banks to try to open his account. And they had no clue. Like, they were trying to send him to their IRA specialist. They were trying to send him to a bank. Like, oh my gosh. And but now again, you want checkbook control, because then what it does is it takes the actual like transaction out of the hands of the custodian and puts it in your own. Because then what the idea is, it's come into the IRA, right? So remember, there's like layers to all this, right? So your Fidelity monies go from over here into the self-directed custodian, and then it drops into your checking account. And then you have your checking account where then you can, start saying, okay, hey, I need to repair the windows on this house. I need to repaint. Yeah. I need to recarpet. All different checks, right? And we use the word checkbook, but I mean, you have a debit card, you have online banking. So a lot of times those are separate. So now you've got 3 different parties. If you want to have the perfect system, you have 3 different parties you're waiting on and working with.
Yeah.
And again, think about banking, the banking world. The banking world's not that efficient, right? With fintech, it's becoming more financial technology. It's becoming more efficient, but okay. So this concept of checkbook control is we're taking the control away from the custodian, and no, I want my own control over this thing. So, and again, when we do it this way, it rather than you doing all those transactions we were talking about, having them review the document, having them sign the document, having them send over the earnest money deposit, having them send all these things, right? Fee. The checkbook control is like, no, just take my money and put it into a checking account. I'll take care of it from there. So that does save fees. Now,
so let me interject with that checkbook control part of it.
Yes.
So now the checkbook control happens.
Jump in.
Literally, it's a checking account. It's a checking account. Yeah. You wanted to use that to put gas in your car, you could. Now, don't do it.
Yes.
But the money is
very,
so
very good
accessible that it's literally that way. So
yes.
there's a measure of accountability and responsibility that comes into that part.
Right.
I probably jumped the gun. What were you going to say?
No, that's okay. What I was going to say is there's an even more efficient system in that. What if we combine? Because again,
right, yeah. That's a good point.
I don't know. Again, I've worked with dozens and dozens of self-directed custodians. I don't know of any that are the bank and the custodian all in one. I don't know of that. There might be some out there. We've just never worked with them. But for the most part, the large custodians are not a bank.
Right.
Right? Because again, it kind of contradicts their own business model. It's like, hey, we're making millions of dollars a year on fees. Why do we want to make that easier for people? So what I'm talking about though is I do want to get this point that so not only do we utilize checkbook control, but we have a platform that we've been able to build out that has brought those two worlds together where it's like, guess what? Your custodian and your checking account are one and the same.
So therefore, the movement again between custodial accounts and bank accounts, it's instantaneous.
What is that? What is that? That from Cars, Lightning McQueen. Ka-chow.
I don't remember. Ka-chow.
Yeah,
I don't know.
Your boys were probably your boys.
No, they loved it. We watched it all the time.
They loved Cars. Yeah.
Mater.
Owen Wilson. Mater. Yeah, Mater. That's right. So checkbook control is a really powerful solution. Even more powerful is checkbook control within the same exact account. So you're not layers upon layers upon layers.
And so now you start talking about this accessibility of the money. And so this is the problem that a lot of people are going to be faced with. Is that because when we say it's the Wild West, it is the Wild West now, even more so because now you don't have to go into town to get some sort of contract approved for you to go out and take whatever the cattle you want to purchase or pigs, them hogs. If you've got hogs to buy. So now you've got this access to money to do things, but see, there are still rules that you have to follow in order to accurately operate, which what the custodian was doing to a degree.
Right.
Now that custodian has somewhat been removed. So this is where we would come into play in a lot of this checkbook control environment to be a support to the person who owns it, so that you've got someone who does really basically understand all the rules and laws with it and say, hey, I want to do this thing. What do you think? Does it fit the guidelines?
Yeah. And keeping with our
Wild West theme?
Wild West theme.
Oh, man. What's the analogy?
There's no. I got it.
Good.
There's, we're gonna have ourselves a hanging, right? we want to make sure that you don't have enough rope to hang yourself with, right? Because that's what's happening is you take control. You may have enough rope.
You may rope that cow, that steer, but he might wrap it around a tree and it gets wrapped around your neck.
Your host, yeah. So this is getting morbid. What we want to do is make sure that you don't have enough rope to figuratively hang yourself with, that you legitimately have enough rope to know how to use it right, so you can lasso that there cow that's trying to get away from. No,
perfect analogy.
There's a lot that goes with this. There's so much that goes into this, and you're exactly right. Is again, all the other custodians that you're going to work with are just that. They're just custodians. Right? They're not advisors.
Right.
In fact, so I'm going to share a quick story.
Perfect.
Can I share a quick story?
Everybody loves stories.
It has nothing to do with Betsy Ross either. Again, for
Too
those
bad.
who didn't.
That's right. That's why you got to watch the first one.
Because
when I say Betsy Roth, you'll know what I'm talking about.
Betsy Roth. Okay, so we're an SEC registered investment advisor, right? So there's state level investment advisors. There's SEC. Anyways, I won't get into all those details. But anyways, periodically we're audited, right? We have to file annual filings. We have to do all these things. Well, so we were doing a desk review audit, and again, very routine. They just want to see your books and records. Yeah. Are you're doing everything? Okay, yeah, perfect. pass with flying colors, no problem. I'm having a conversation with a gentleman so the Denver office is kind of one of the big hubs for the SEC. So I'm having a conversation with one of the higher ups there because they wanted to bring him in because they're like, okay, this is pretty unique. You're doing this self-directed thing. We don't really ever see that. Let's talk about this. I'm like, yeah, for sure. Like, we want to have this conversation. And I don't remember the gentleman's name because, man, as soon as an SEC audit's like a root canal with an IRS auditor. Like,
at the same time?
It's like an IRS auditor giving you a root canal.
You got to go through your receipts while they're drilling in your teeth?
Oh, yes. So, but again, pass with flying colors, no problem. But I'm having this conversation where I'm like, okay, hey, look, here's the deal. I want to ask you a question. I'm like, here's the funny thing. So, because the whole conversation was, well, again, in our shoes, what you and I are doing, we're the advisor, right? There's pretty sharp clause that the SEC has if we make a mistake, right? Like, it's a big deal. Like, we're not just talking criminal, but or not just civil, like criminal. I mean, it's like the whole kit and caboodle. Like, they've got some pretty sharp teeth, some pretty big claws. So, anyways, I'm having this conversation, and the again, he's a higher up. Like, we're not talking like entry level desk auditor for the SEC. I mean, he's a pretty big deal because they had some questions as to, okay, well, do you guys need to count this as assets for your firm or not, right? Anyway, so I'm having this conversation. I say, hey, I just want to pick your brain for a second. You see hundreds of different companies. You do all these audits, yada yada. I'm like, but you guys don't regulate. It's not your job to regulate the custodians, right? He's like, nope, not at all. Yeah, like I don't want to say they have more leeway because they definitely have regulation, but he's like, yeah, no, we don't regulate them. And I'm like, okay, so I literally just dealt with this with a client where the dollar amount that she transferred over to me as an advisor, her annual amount of fees that she was paying to me were about 40% less. I said, so she's paying a ton of fees to this custodian. I said, and they're not even able to give her any advice. Like, how does that make any sense? Like that I'm like, because again, you regulate me. You make sure that if I'm doing anything for this person, that I'm doing it in their best interest. Yeah. That I have, you're looking at my books and records to make sure I'm solvent, that I'm making good decisions, that I'm helping every client independently, that I'm giving them specific tailored advice. A laundry list of garbage not garbage, they're good things, but things that we have to do. The custodian's not, and they're charging this person almost double what I'm charging them. I'm like, how does that make any sense? He's like, yeah, you're exactly right. It makes no sense. He's like, but they're not my jurisdiction, so I don't care. You know what I'm saying? So that's my point is, as an advisor, my job and the whole reason that I'm here is to make sure that you do it right, just like a custodian would do. But more importantly, like from a holistic standpoint, from a big picture standpoint, from a you want to retire in 10 years and have enough money standpoint, like, is this still the right thing for you to do? Oh, and do we want to, because we're going to talk about the Golden Roth here in a minute. Is it maximizing your tax? But anyways, so this is my point is, yeah, exactly. As an advisor, we're here to make sure that you do it right and help you do it right and give you advice as to, does this make sense big picture?
I just had an epiphany.
Anyways.
We're creating a segment, Story Time with Ty.
Ooh. Ty, story time.
It's going to become a segment. It's story time, kids.
We need to
lay down, close your eyes, and listen to a story.
Why was it boring?
No.
Is that why?
Story time. Everybody loves story time.
Story time with Ty.
See?
Did Ty paint a picture
and
for
you're
you in
fitting
your mind?
With the Wild West theme. We're all gathered around a campfire, listening to a story time with Ty.
Gather around the fire.
But see, that's a really good point in bringing up because now, when people go to self-directed IRAs, and you and I have been involved with self-directed IRAs for 15, 20 years, however long. I don't even know how long it is, but it's a long time. Right. People had these self-directed accounts, and they were literally on their own. Literally. They were left to themselves to try to figure out how to make everything work, and so few people really had the necessary tools to make it work. And this kind of comes back to the other point, which is, the other issue with self-directed custodians is money is in cash. It's doing nothing. right? It's doing nothing.
Yeah.
But if you're working
Yeah.
with an advisor,
Yeah.
now they can say, okay, well, let's just move it over to this account and let's get that invested while it sits and waits to be invested in other ways.
Yeah.
And it can earn and grow while it's doing that.
But let's clarify that, because there's two pieces. I want to dive a little deeper right there, because there's two really key pieces right there. Really, really important. Because I want you to think about what are the intentions of this of each of all the parties involved in that. Okay.
Yeah.
Because think about this: the custodian, while they don't offer typically they don't offer a bank account, right? They still have their own company bank account that your dollars are sitting in.
Yep.
Right? They have to, right? They are regulated, so your money is
It's
somewhere.
FDIC
So
insured.
like, if you say, "Hey, I need to," yeah, exactly. They're making interest on that. So that the one company that has $400 million, again, I'm using that company
Second time
example again. You have $400 million on deposit. They're making money
Yeah.
on that deposit. Okay, so keep that in mind. So for them to take that off that platform, they're like, frick, Okay, so that's one thing. Number two, with the other platform on the what we called in the first podcast, or the first
The
episode
hybrid
of this one, the conventional
conventional
custodian.
side. Mm-hmm.
There's not incentive for that advisor to want to go back and forth, because it's like, oh sweet, you've got $1 million with me, but you want to take 300,000 again. There's no incentive. Like he or she, the advisor in that situation, has zero incentive for you to pull that off their books and don't make money on it, right? So again, coming back to this hybrid system we're talking about, it's like we don't care where your money goes,
Yep.
either or, right? We don't care. We do not. What we care about is where are you going to make the highest, best return with your dollar? Now, maybe it's flipping a property. Okay, that's great, but you got to here are the risks, right? You got to understand there's a lot of risks. And guess what? Ryan and I have dealt with hundreds, if not thousands and thousands of clients and people who've done those kinds of deals. So we've got an idea of a few of the mistakes that have been made. So let's talk about that. Whereas, again, you talk to the other advisor somewhere else with the conventional firm that's like, yeah, well, I've dealt a ton with REITs, or I've dealt a ton with stocks and bonds.
Bought my own house.
But, I don't know. I've never had a client do a flip. Yeah, I've flipped my own. Yeah. Again, and the same thing with the custodian, right? So it's like, yeah, but you're exactly right. This hybrid system, right? The monies can go back and forth to a platform that will give you the highest and best return. Now, again, obviously there's risk, people. There's always risk, no matter what. But it's understanding, and that's the job that you and I have, is to always quantify how much risk are you taking. And technically, if you're sitting in cash in your self-directed IRA somewhere else or wherever, that's technically still a risk, because you're missing out on it's inflationary risk, right? As money is
losing opportunity.
Yeah, you're losing dollars. Now, is that as big of a risk as putting $100,000 into a property and trying to flip it and maybe you lose $50,000? No, obviously that's a much bigger risk. But my point is, there's risk all over the place. My point is, we'll help you evaluate that risk, because we want to make sure you use the self-directed account the right way. Right.
So that kind of starts to create resolve these problems, these solutions that are really needed to make it work, right? The hybrid system, again, you can go listen to the first one. We talk a little bit more about it, but it's important to bring that up here because we can get some more, a little bit deeper into what those solutions are. Now, we're going to make a teeny bit of a move here, because now we're going to talk that within this system of self-directing, hybrid, checkbook control with an advisor system, we're going to talk about this solo 401k. Starts to become the pinnacle. Right. Is this the pinnacle? It's close, right?
Yeah, pinnacle.
If we're talking about somebody really wanting to maximize and get the best out of their retirement account, right?
Absolutely.
Now,
absolutely.
Go ahead.
Now, I will. Okay, I will say though. So as people are getting all excited,
I'm getting excited.
There is one restriction. I am too. I can hear your voice as well, and I can see it on your face. So the other thing, though, too, is people have to understand there is one IRS restriction as it starts to relate to the solo 401k. If you've got a Roth IRA.
Wah, wah.
Roth IRA is the only thing that cannot. Is that somewhere in there
nope.
later? Where
I'm just saying, for people who have a Roth, it's a wah wah.
You can't. Yep. Yeah. Again, here's the thing: you can still do a self-directed Roth IRA. You can still have self-direction.
Yes.
Exact same functionality. All these cool tools we're talking about, you can still do it. You just got to realize So Solo K. We're going to talk about how you can have Roth inside of it. You just can't roll old Roth monies into a brand new
if you have an existing
Solo
Roth IRA, this is not for you.
Yep. But the self-directed IRA still is.
That's right.
Just not the Solo K. Yep.
Sorry.
Okay.
I was wanting a little too much there.
Perfect.
But this Solo 401k is built with traditional money. Right? Episode 1, we went through that. Okay, built with traditional money.
And it can be Roth. It can be Roth.
You can't come from a Roth. You just said that.
Okay, sorry. Correct.
Don't confuse the people.
Roth, but you can. Okay, sorry. Okay, I'm going to take a step back.
Now, a Solo 401k, everybody thinks of, that's associated with my job. Right. So you can set up a Solo 401k as a sole proprietor. You can set it up as owner of an LLC if you're the sole owner or you're only owners, right? S Corp, C Corp, all of those things.
Yep. Right.
You can also transfer into a Solo 401k any money that is traditional money.
Yes.
It can come from an old 401k, it can come from an IRA, it can come from a SAP, all of those. Right? You can roll them into it.
Yep.
So,
TSP, 403B.
So I'm assuming there's going to be a ton of questions on this because I think about it as I explain it to people as well. Some of the main questions that come up are things like, but I don't have a company. So,
right. No, great point. No, good point. Good point. Because technically this is built around now your company for new contributions. Because there's I take a lot of steps back a lot of times. Let's take a step back. So remember, what most people are used to is the employer 401k that you've had with General Motors, with Target, with
GE.
I don't know. Where's another? GE, General Electric. What's a big company down in St. George? A lot of people. SkyWest. Or like Adobe's up here, right? Adobe's across the street from our office up here in Salt Lake, or in Lehigh. So you work for Adobe, you have a 401k. That's an employer 401k. Okay. So if you're building that up, if your current employer plan allows for rollovers or rollouts, you can take that out and put that into your 401k. Or let's say you worked for Adobe for 25 years, you've left, and now all of a sudden you want to roll that money, you can roll it, right? Once you've left employment, you have full control over where you want to move those monies. So we can build a new Solo K around, it has to be a viable business. You can't just make one up and never have an actual business. But here's the thing. You don't actually have to show income for that business. Only if you want to make contributions, put new dollars in, which we're going to talk about in a second because this is really powerful when you have a business. But let's just say I just left Adobe and I am doing some consulting on the side, right? And maybe all I make is, heck, you may maybe not even anything consulting related to what you were doing at Adobe. You may have a dog walking business. You may mow lawns for 3 or 4 neighbors, and that's your business, right? So the point I'm getting at is the Solo 401k is exactly, that's why we call it the Solo K. There's other, like I've heard people call it the single K.
I don't like that name.
Or the owner K.
Solo K.
But yeah, no, that was
Solo K is the best
one. Solo K. So you're right. So if you have not incorporated, so you don't have an actual business name or a tax identification number, you technically are considered a sole proprietor, Schedule C, right? So as long as because what it's going to come down to is if you're ever audited, you have to show that, I was able to create this because I have a business. It's like, so do you have any kind of, so I do some consulting, or I mow lawns, or so for example, my brother and I, we've got some property that we take people, we do guided hunts, right? so random, has nothing to do with anything I do on the financial side of the world. But I could build a solo, and we'll get into this even here more in just a second, because this, again, it's going to get really powerful in just a minute. But again, so you have that sole proprietor, you have that LLC, you have that S Corp. Now here's a key, very, very key, crucial piece of this. You cannot have employees and do a solo 401k.
No.
Oh, sorry, owners only.
They can.
You said employee.
They themselves can be an employee, but they can't have an employee that is only an employee owner, yes, in the company.
Correct. So let's talk about it. And you actually can still do a solo K. We just there's a few things you got to make sure that happen. And let me explain what we're getting at here. What we're getting at here is the fact that the IRS doesn't want. So let's use you for an example, Ryan. Let's say that you've started you and your son's very big into theater. You're big into music. Okay, and you guys have started
I like
production
this. I like where
company.
it's going.
Okay, you guys have a production company. But now it's just you and your son. You both own it together. You're both owners. You have no employees. Okay. You guys absolutely can set up a solo 401k. Right? Yep. Now it can all be the same plan, and you each have your own, setups of that solo 401k. Right? So the name solo is a little bit misleading, but what it means is like you're the sole, there's no employees really is what we're getting at. Now, if all of a sudden you guys wanted to hire employees, that's fine. You can. What has to happen for you to still be able to build a solo K is that you have to offer your employees a retirement plan, because the IRS doesn't want you getting all these cool tax benefits, but you're kind of hosing your employees. So you and your son hire a couple of people to help you guys, right? Some sound mixers, people that do lighting or whatever. Now, if those individuals are just independent contractors, that's fine. They don't work for you. So you can still meet the guidelines for the solo K, right? So again, you and your son own this business 50-50, okay? And you guys make money. You can roll an old 401k into this new solo K plan.
Oh, perfect.
From an old job that you left. And you can also contribute. We're going to talk about the contributions here in just a second, but people are starting to understand what it takes to actually build a solo K, right?
Can I invest into real estate with this solo K, Ty? When we roll this money over, can I do that?
I'm glad you asked. Yes. So here's the thing that we're talking about. Not only can you do that, but let's just say, let's carry this example. Let's take it a few steps further. So again, you and your son partner up. And before you and your son started this, let's say you had been working with SkyWest for 15 years. And between you and SkyWest, you had saved up $250,000. Okay, so now, man, good job, dude. Way to save. Now you move that $250,000 over to one of these platforms, okay? And if it's a platform we helped you build, you actually could leave that money invested and have the solo K self-directed with the checkbook control we're talking about, that self-directed solo K. You could have both of those together. So you move the monies over, it's going to sit for a while until you're actually ready to use it for something. Now I don't want to get into all the details in this podcast because there's just so many moving pieces. But again, this comes back to the point why we're advisors and why we help people with these. But yes, you can move those monies into a solo K, and you then can start moving. Now we're going to talk about contributions here in just a second. But so again, those monies that rolled over don't impact new contribution levels. And there is no limit to that. So if it was $250,000, if it was $2.5 million, doesn't matter. All of that can be rolled into the plan. Okay. And then coming back to this original thought too, as long as you have no employees, you and your son are totally fine to set that up. Okay. Now, if you did have employees, that's fine. We just need to make sure that you have some sort of a retirement plan in place for all of them. And then you can start looking at setting, because I have clients who have other businesses. We provide their employees some kind of a retirement plan, and then now they're okay to do their solo Ks. Okay. So yep. And again, a quick reminder, the functionality of the solo K and the self-directed IRA, exactly the same. If you want to buy your real estate, like you just talked about,
what you're saying to me,
super easy.
is you're saying that this is probably something I should do.
Well, what I'm saying is, if you want,
me personally,
if you're sitting here and you're like,
myself.
hey, look, oh, you personally, yeah, oh yeah, of course.
I know.
Well, you and I already have these built out.
I hear you.
You already have it. You already have a solo K. But what? Yes. So again, it comes back to individualized advice. I can't answer that question blanket answer to everybody. What it comes down to is, well, what do you, the individual, want to do? What's most important to you? And if you want to have more of that control to do these things you want to do, absolutely you should want to build this, because like you're saying, if you want to go buy real estate, if it's sitting with Fidelity, you're not going to be able to do that. So now these are rollovers, right? I think we also want to take a minute and let's jump into the contribution side of this, because
gets powerful,
this is where it gets powerful.
And it's the same thing as far as, should you set it up, or, how this works for you is just going to depend upon what your situation calls for, which would also include taxes and a tax person to help you with that. But very simply, Ty, very simply.
Right.
You hear me? Simply. You can. I know. I believe in you.
Do that.
There kind of are two ways to contribute. Two mathematical calculations.
Yes.
Go through those.
Yes. Technically, it's 3.
2A, 2B.
But I'm splitting. I'm
nice.
Yes, 2A, 2B. I'm splitting hairs. So there are 2 ways to contribute. Now the amounts change, but let's just tell people. I mean, what I want people to understand is just how powerful this is. With a Roth IRA and a traditional IRA, you're talking $6,000 or $7,000 a year.
It's okay. It's all right.
Solo 401k, we're talking, high 50s to mid, 50,000, high 50,000s.
That's a little better.
60,000s, depending on age. Yeah, that's 10. I mean, 10 times the amount. Like, that's pretty powerful. And not only for just you, but it's like if there's 2 or 3 owners, all of those people. Now, and again, there's no limitations either because as you start to make more money in the IRA world, as you make more and more money, you phase out of being able to contribute. Like Roth, right? You can't contribute to a Roth IRA if you make too much money. Guess what? In the solo 401k, it doesn't matter. If you're making $500,000 a year, you can absolutely still build a solo 401k. But back to your point, there's 2 ways that those monies. Again, remember, we're not talking about monies that have rolled. So in Ryan's instance, right, he rolled over $2.5 million. That does not impact these contribution limits at all.
Yeah.
Unlimited rollover amounts, totally fine. Now, new dollars, new tax strategized dollars coming into the plan. You and your son could each contribute with your ages right around $58,000 a year and some change. Okay. Now, there's 2 ways that we look at it. One is if you're wearing the employer hat.
Where's your cowboy hat?
That's what's... I forgot my cowboy. I need a cowboy hat because I'm the new sheriff in this Wild West. Okay, so the first one is, as the employer, it's called revenue sharing, right? Revenue sharing just means how much of the net revenue are you pulling out and putting into your solo 401k. There's a specific calculation. We're going to tell you what it is, but again, it's like this is one of those things. It's like, now we're starting to work with like the long and short is it opens a very large door to push a lot more money in. That's going to give you some pretty powerful.
You're going to be able to buy way more cows. Okay.
But the idea is what? Yeah, a lot. You're buying a lot of cows. You're building up a nice little herd here pretty fast. So, what the calculation is as the employer, because again, you and your son are the employers and the employees, right? There's no other just pure employees like you said earlier. So you and your son, this calculation when you're doing revenue sharing is you can contribute up to 25% of net revenue. So if you and your son gross $1 million, okay, and then all of a sudden you are sitting on $500,000.
And net revenue would just be we've subtracted out all of our expenses. We've taken away all what we spent on that year that are business deductions.
Yep.
And now we're left over with this 500,000. Yeah.
Right. Yeah, and you're going to pay a lot of taxes. Right? Well, now you and your son can say, wait a second, we want to carve off some contributions. 25% of that dollar. You guys, up to the 58,000, you guys can carve that off as per person. As the, well, again, what we're calling the revenue sharing piece. Now, there's also what we call deferred compensation, which is what more of us are really used to, because deferred compensation, and there's different caps on this one, right? Because it's not quite the full 58,000. There's different caps, okay? And the reason that I said there's kind of a 2A and 2B is that when you do deferred compensation, what it is it's like, okay, you, Ryan, are technically taking part of a salary in your small business, and rather than you actually being paid that salary, you're deferring it back into the plan. Just like what you were getting with SkyWest, right? That's deferring your compensation, right? Because you remember, rather than you getting paid, $5,000 every 2 weeks, they would only pay you $4,500 every 2 weeks because you deferred some of your money or your compensation into your 401k with them, right? Same exact concept. And so you're able to defer some, and then the employer is able to match that inside the plan, okay? And again, we don't want to get too complicated here on the podcast because there's a lot of moving pieces to this. But the long and short is, as you start to work with your tax professional, and as your advisors or whoever you're working with, as you start to build this solo K, the long and short is it opens up a much larger corridor for you to put more money in. And
very simple answer. Very simple answer. Thanks.
We're really getting along on time here. Well, last thought with that too. I know. I told you I couldn't be simple. I told you I couldn't. Okay, last thought, because this is where this gets really powerful. And I know we're just about out of time, so I want to wrap this up. But where we get really powerful is, again, remember, if you're making a ton of money, you phase out of being able to put Roth contributions in. Again, remember, so traditional monies are pre-tax, so you save on taxes today, but you pay the taxes on the back end. There's instances where you don't care if you're paying taxes today, even if you're in a higher tax bracket, because you want some Roth dollars, right? Stuff that's already been paid, right? And again, there's reasons why you want to do this, and that's a whole different discussion. But we're not talking tax strategies right here. So Ryan, you could max out your side of your 401k contribution and immediately convert that into Roth. So really what I'm getting at here, what's so powerful is you can almost get, 50 to 60 grand plus into your solo 401k, which is still self-directed, and have that converted into Roth dollars
obviously,
inside your account.
Are you paying tax then on the amount that you've contributed to the 401k that is now turning into a Roth 401k?
Roth. Yes. So essentially what's happening is you're simultaneously getting the deduction, but then you're converting it so you kind of lose the exact same dollar amount of deduction, so it washes itself out. So long and short is, no, you're not getting the tax deduction today. But that's okay because that might be the strategy that we're going for, right? And some people may be saying, well, wait, why in the devil would you want to not be saving taxes if you're to our point in our example, Ryan's got so much net revenue left in his business. Why do we want to all of a sudden now pay more in taxes? Again, I don't want to jump into that right now because there are reasons. But the long and short is there are reasons to do the Roth, and there are reasons to also do the traditional. And it really depends on each person's tax scenario. But what I'm getting at is this. It opens up a very big corridor that gives us a lot of opportunities to get into some pretty cool tax planning. And when I say that, when I say we, I'm talking about your tax preparer, you helping build this 401k, us as your advisors so it's like we start to then get into this world where it's like, man, this is cool. Now, and also if your partner or your spouse, when I say partner, I mean life partner, or your spouse, if they're a part of your business too, guess what? Like in your household, you're talking $100,000 plus a year that you can be saving and contributing that can also have Roth, potential. It's crazy powerful what this can do for you. And not only that, but you've got the self-directed component to this, to where it's like, man, I can supercharge my savings for my retirement, and I have control over it.
Well, and so,
it's a powerful tool.
That's basically all we really wanted to go through today. But what's really cool about it, and this is kind of the point you're bringing up with a lot of it, is that, we're just giving you the basic overview of it, because there are just nuances and differences for every person that's involved. And so everybody needs to have a very specified plan put in place to know, how is this going to be set up directly for you. So you got to work with people who will kind of understand what they're doing. So this is just a basic recap here, right? We've talked about the checkbook control component, right? How that can help. We've talked about, eliminating sort of some of these middlemen, right? The custodian and the bank account, middle people. Nobody likes middle people. Let's get rid of as many middle people as we possibly can. And the ability to utilize your money more effectively and putting it in different positions that you can, right? Investing it in different ways, real estate, other places. And then you start talking about the solo 401k, which is in and of itself a whole new system, but it definitely needs a more personal touch to make sure that it works and figures out the right way for you. So this is like the bookend between part 1 and part 2, right? This is the essence of a lot of things that we end up talking to people about, because if you've got retirement monies, or if you've got investment monies to work with, right? These are the types of discussions you really need to start having, is how to maximize what your money does, where it's at, what it does. Yeah. And that's where we're going to fit into this whole thing, and particularly moving forward with these podcasts, we're going to talk a lot more about all this kind of stuff.
Right. Exactly. And that's the key point. Where did this whole thing come from? It came from, between you and I, 20 plus years.
Yeah.
Right. Between the two of us, we're probably 30 or 40 plus years. A lot of years of us talking with people and wanting to really make sure that the entire universe is opened up to you for investing and diversification, and really building a true platform that is really powerful. Because again, it's a tool we want in people's hands. We want to put it into their hands, but we also want to make sure that they're doing it the right way. So that's what we're here for. And the last thing with that too is that you've got that tool, but there are ways, whether it's with us or whoever, I don't care, but there are ways that it can be done extremely efficient and very cost effective, and it can still marry those two worlds together so that you are maximizing both sides of the table, both sides of the equation, right? Because in that world where those two custodians don't play well together, well, guess what? We've got a way to connect those worlds in a very efficient way. It's been a long time coming, but I think we've got there's a really cool tool.
And it's exciting
really
talking to people about it.
It's
new, it's different. No one really has any sense in when they actually see it. And the light bulb goes off. They're like, what? That's cool.
Right. You know what's funny?
Hey kids, settle down.
Way over time, but
settle down. Sit down. Hey, sit down.
Sit around.
Here we go. It's Ty Hansen's story
time. Old man Hansen. No, it's so funny. But I had an advisor once, and nothing against this other advisor, but he's told his clients, like, I've never heard of this. I think it's illegal. You shouldn't be doing this. This is crazy. And my potential client was like, well, what is this? Like, I want to make sure, like, I don't want to do anything illegal. I'm like, no, not illegal. Not in the least. This is literally, again, and I think that came more from a place of fear from the other advisor, that he didn't understand what it was. No, this is not illegal. This is and he's like, I just want to be able to see how is this possible? And I literally sent him like 2 web links from the IRS's website showing how these things work, right? And that's what I'm saying to you, exactly to your point, is they're just 98%, 99% of the financial world hasn't really used these tools, and they're there. And of the 2% of people that are using them, unfortunately, most of them are using them in a really non-cost effective way. They're really expensive. Our goal is to build this tool that's really, really useful and powerful. And that's the point.
Cost effective.
A lot of people just don't.
Wow, good one, Ty. I'm wasted.
All right. Good times.
I'm tired now. Yeah.
I know.
We got
appreciate people staying with us.
Yeah. MyProsperTeam.com.
Where can they subscribe to the podcast?
Hang out there. Go there. Subscribe to the podcast.
That's right.
Yeah, download it. Listen to it. We're going to be every week. We're going
to
bring you whatever we got on our minds, and hopefully you like it. We got a lot to unload on you, so hopefully you like it.
That's right.
Ty, appreciate your time, man.
That's right. All right, brother.
All right. We'll see everybody next week.
It's always fun, my man.
See you, bye.
Thanks, buddy.
Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you like what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.